everyone, and welcome. Are you tired of looking at your savings account and feeling like it's just not really doing much? Well, if you want to learn how to actually build some serious wealth in the Indian market, you've come to the right place. We're going to skip past the basics and jump right into some really powerful data-driven strategies that can help you get ahead of the game. But let's start with a really important question, okay? It kind of gets to the heart of why we're even talking about this. Just take a second and think about your savings, your investments. Are they truly growing, or does it feel more like they're just treading water? Because here's the wake-up call. You hear in the news that the official inflation rate is, around 5%. But does that actually feel right to you? I mean, think about it. Does it feel like your grocery bill, your rent, your kids' school fees are only going up by 5% a year? No way. The reality that you and I experience every single day is a whole different story.
And that brings us to our first big idea, the real inflation hurdle. Now, this isn't some number you'll find in a government report. This is the actual real-world benchmark that your investments absolutely have to beat, just for you to break even.
So let's break down where this real cost is coming from. And this isn't just a guess. This is based on hard data. Food prices, they're going up over 10% a year. Medical costs are shooting up by 14%. Education, 11.5%. And if you live in a major city, you know this one. Rent is jumping by a staggering 16% every year. This is the inflation that actually hits your bank account.
So when you mix all those essential costs together, what do you get? Your actual cost of living is climbing by an average of 8.4% every single year. That number right there, that's your personal hurdle. Any investment return you get that's less than 8.4% means you're actually losing money. Your purchasing power is going down. You're going backwards.
So the big question is, how in the world do we clear that hurdle? Well, this is where we shift from looking at the problem to finding the solution. We need a tool that's powerful enough to not just meet that 8.4% mark, but to blow past it. And you know what? That tool is stocks.
This chart just lays it out so perfectly. See that line at 8.4%? That's our enemy, the real inflation hurdle. Now look at fixed deposits, or FDs. At 7%, they don't even clear it. You're losing value. Gold, at 9.5%, just squeaks by. But then, look at stocks represented by the Nifty 50. At over 13%, they're giving you real, meaningful growth, well above that hurdle. Now, I know what you're thinking. Investing in 50 different stocks sounds complicated, right? But it doesn't have to be. That's exactly why pooled funds, like mutual funds, exist. Think of it like this. You probably can't go out and buy a 10-crore piece of land by yourself. But what if 1,000 of us each put in 1 lakh? Suddenly, we can. A mutual fund does the exact same thing with stocks, and you even get a professional to manage it all for you.
Okay, so now we know what to invest in. Let's talk about how. We're going to start with a really simple but incredibly powerful upgrade to the way most people already invest in stocks.
So, when you put your money in a standard Nifty 50 index fund, it's something called market cap weighted. That's just a fancy term that means the biggest companies get the biggest piece of your money. I mean, look at this. The top 10 companies make up more than half of the entire index. That's not really diversification, is it? It's actually a huge concentration of risk in just a handful of giants.
But what if there was a different way to do it? Well, there is. It's called an equal weight index. It's so simple. Here, every single one of the 50 companies gets the exact same slice of the pie, 2% each. This gives you true diversification, where the potential of smaller, high-growth companies isn't totally overshadowed by the big guys.
Okay, so does this little change in weighting actually make a difference? You won't believe the data. Over the last 5 years, a regular Nifty 50 fund gave you about 11.6% a year. Not bad. But the Nifty 50 Equal Weight Fund? A massive 16.9%. That's an extra 5% return every single year just by making this one simple switch.
Let's really let that sink in for a minute. This one tiny tweak, switching your monthly SIP from a standard index fund to an equal weight one, could mean your final investment portfolio is more than double the size over the long haul. Think about that. More than twice the money for literally no extra effort. It's incredible.
All right, for those of you who want to be a little more hands-on, maybe take the wheel a bit and aim for even higher returns, let's dive into a couple of active investing frameworks. Now, these do require a bit more attention, but as you'll see, the potential payoff is pretty huge.
So the first strategy is what we call the calendar hack.
And it's based on something that happens like clockwork in the market. Twice a year, every March and September, the list of companies in the Nifty 50 gets updated. When a new company gets added, every single index fund out there has to buy that stock. This creates this huge, predictable wave of demand that usually pushes the price up. So the strategy is super simple. Find out what the new stocks are, buy them, and just hold them for a year.
And the results of this simple, logic-based strategy? When we backtest it, which just means we see how it would have done in the past, it shows an average annual return of, get this, 33.1%. That's what can happen when you understand and act on the mechanics of the market.
Okay, our next active strategy is all about finding the absolute best individual companies. We call it the alpha screener. Just imagine it like a powerful filter. It starts with this huge universe of over 6,000 stocks, and it sifts through all of them, looking for really strong fundamentals, things like great sales growth and high profitability, to narrow it all down to a focused portfolio of just the top 10 strongest businesses.
And the performance of this super-filtered quality-first approach? The backtested average annual return is an absolutely mind-blowing 63.6%. This just shows you the incredible potential when you move beyond the broad indexes and into picking high-quality stocks backed by data.
And for our final section, let's talk about the most modern framework of all, using artificial intelligence to cut through all the noise and get real clarity in a very complex market.
We've all been here, right? It's a problem every single investor runs into. You're researching a stock you're interested in, and you're just hit with this flood of conflicting advice. One big firm says buy, another one says hold, and a third one says sell. I mean, they're all supposed to be experts, so who on earth are you supposed to trust? It's enough to make you just give up.
This is where AI just completely changes the game. Instead of you trying to read one or two reports, an AI can analyze all of them instantly. Just look at this example for ICICI Bank. The AI scanned 46 different professional analyst reports, and you can see right there in the table, 41 of them, a whopping 89%, rated as a buy or strong buy. In seconds, AI finds the consensus among the experts.
But it gets even better. It doesn't just stop at buy or sell. By analyzing the price targets in all those reports, the AI can give you this powerful, actionable insight. Based on that overwhelming professional consensus, there's an 89% probability that ICICI Bank will return at least 22.2% over the next year. It literally turns confusing noise into a clear, data-backed probability.
So when you think about everything we've talked about, from understanding your true inflation hurdle to using smart passive strategies, active frameworks, and even AI, one thing becomes crystal clear. Data gives you an edge. It gives you a logical, structured way to build wealth. So the only real question left is, how are you going to use it?